Hello, everyone, and welcome to Schwab Coaching. My name is Cameron May. I'm an education coach here at Schwab, and this is Advanced Charting Techniques. And today we're going to be talking about how a trader might use charts to plan the week of a trade, the day of a trade, and even the moment of a trade. This is going to be a fun one. We're going to be incorporating pivot points into today's discussion. It's going to be new to some of you. We're going to get into details of how a pivot point is calculated, and how it might be used to plan, even right up to the precise moment of entry on a stock trade. Before we can get to that, though, let me first of all say hello to everybody that's joining us out there on YouTube. Hello there, David and TMTM, Chris B, Life in the Fast Lane, Robert, Ben, George, Sharon, Jay Richardson, Zavel Kumar, AJ, and everybody else. Thanks for joining us week after week. We really always do appreciate your attendance, your contributions in these Friday discussions. If you're here for the very first time, I want to welcome you as well. And if you're watching the archive of the session after the fact, you're just watching the video on YouTube, fabulous, enjoy it, but be aware that you're invited to join us in this discussion. If you want to be in the live stream, it is Friday. These happen on Fridays at 1 o'clock Eastern time. We'd love to have you here. I also want to let everybody know that my very good friend Connie Hill is hanging out in the chats with the live stream audience. She's going to be addressing any questions that I can't get to just in the natural flow of the presentation. Thanks for being there, Connie. And Connie and I would also like to issue an invitation to everyone, whether you're watching live or you're watching the archive. If you're not following us on X, please do that. It doesn't cost anything. It only takes a moment to follow us. You can find Connie on X at Connie Hill CS. You can find me there at Cameron May CS. And it really is the very best place to connect with your favorite presenters in between the live streams. All right, but let's get right into this. Planning trades to the week, to the day, even to the moment. But as we get into this, we need to bear in mind these important disclosures. Risk is real, so bear these disclosures right there top of mind. The information here is for general informational purposes only and should not be considered an individualized recommendation or endorsement of any particular security, chart pattern, investment strategy. Options carry a high level of risk and are not suitable for all investors. Any investment decision you make in your self-directed account is solely your responsibility, and Schwab does not recommend the use of technical analysis as a sole means of investment research. All right, so let's set the agenda for the day. I think just about any trader can relate to the desire for precision in entering a trade. But how might charts be used in pursuit of that sort of an effort? Well, we're going to be talking about how charting indicators might be used to assist with the planning of trades down to a weekly basis, down to the day, and maybe right on down to the very moment. It's going to be a combination of a number of indicators. We'll go at a pace that everybody can follow. This webcast series typically taught at a medium, intermediate to advanced level, but I still don't try to leave anybody in the dust. So let's get right into this. Let's go right to the desktop, the Thinkorswim desktop software platform. And I have a chart of the S&P 500. We're just going to take a glance at it to just sort of set the stage for a bullish example trade today. So with the S&P 500, you can see, we're pulling back a little bit today, down about 0.25%, off a little bit. I know that nobody likes to see, or at least among the bulls, we don't like to see those red candles, but we're really trading just, a percentage point or so off all-time highs on the S&P 500, and it's been a great run for the last 12 months and extending well beyond that. So let's just say that our hypothetical trader out there has looked at today's market conditions. They think, all right, a little bit of a pullback. Maybe that's just setting us up at maybe some support opportunities, and they're thinking maybe getting into a new stock position. Janelle, absolutely my pleasure. Glad to have you here. Janelle says thank you to me. And you're still learning. I think everybody is. I'm still learning on a daily basis. I research stuff and I think, oh, that was a nifty little discovery there. I hope that everybody else, when you're attending my webcast, you have a lot of those experiences as well. But let's just say that our hypothetical trader still bullish on their outlook for the S&P 500, despite the last couple of days of very small downturn. And so they're working on attempting to refine the timing of their entries. So I'm going to use a few. Well, let's use at least one example stock here. We'll see what time permits for additional examples. But I want to bring up Procter and Gamble. Bit of a choppy chart. How might a trader employ technical tools to refine their entry on a stock like Procter & Gamble, so choppy, but drilling it down to that weekly, down to that daily, down to that moment of entry. So let's talk about the little bit intermediate to longer term perspective first, refining things to maybe a weekly entry. And that is, we're going to use a longer term-ish indication of trend. Now, the first couple of indicators here, unlikely to be huge revelations to a lot of you who follow this webcast series on a regular basis. We're just going to employ a couple of exponential moving averages. So I'm going to come up here to our little gear icon. And let's add those moving averages. I'm going to type in EXP or exponential, highlight moving average exponential in the menu of potential indicators. And I'm just going to click add selected twice. So that's going to queue up a couple of potential exponentials. Try saying that 10 times fast. I did it twice already. Anyway, a couple of moving averages to be added to our charts, but I do want to tailor these a little bit. Now, if we were looking for a very short-term trade signal, maybe a trader might use just a few candles worth of data. We're looking at daily candles here, so they may be looking at just a few days worth of data. And by default, that's sort of what Thinkorswim's moving averages do. They default to the last 9 candles. In this case, it would be 9 days of data. I'm going to expand those out. Those might be serviceable for a very short-term signal. Let's extend those to maybe the intermediate to longer term range. As a matter of fact, we're going to use one of these to represent intermediate trends. How about we change this first one to a 50, looking back over the last 50 days. I'm going to change its color scheme so that we can distinguish between the two, but I also recognize not everybody has has that ability to see the difference between some of these colors. So I'm going to change the thickness. I got a reminder of that in a comment recently. Hey, Cameron, for those of us who have some color blindness to one extent or another, could you assist with that? Yeah, let's make this one, the 50 period moving average, a little bit thicker, 3 out of 5 in thickness, and we'll click OK. So it's the red one or the thicker one. The other one is going to be our longer term indicator of trend. We're going to use the gear icon here, and we're going to switch this to 200 days worth of data. And I'm going to leave that one green. I'm also going to leave its width at 1 out of 5. So the longer term moving average is going to be the green one or the thinner one. So we'll click OK, we click apply, click OK again. And so now if you're not familiar with moving averages, it really is, these are just lines that represent average prices of Procter & Gamble over specific periods of time. Now you saw me select 50 and 200. So our red line is looking back over the last 50 days. So basically from here to somewhere back here. And it's saying, hey, Cameron, over that period of time, the average closing price has been $171.60. So that's where our red line finds itself right now. And those average prices, those 50-day average prices change over time. So we see this line change over time. And so for some, they see this as sort of an indication of where the intermediate term trend seems to be headed on Procter & Gamble. Now, for those that are looking for longer term trends, they might look at something like this green line. It has a current value of 166.74, which is telling us that over the last 200 days, so ranging all the way back to about here, the average closing price has been about 166.74. It's incorporating a lot of lower price days on Procter & Gamble. So you can see that that line is lower. So what some traders will do is they'll use one or the other of these sorts of moving averages, or even the interplay of the two, to indicate potential timing assistance with the planning of trades. Harry, thanks for the thickness variations. You thought, although you prefer the thicker line or the longer line to be the thicker one, yeah, I can go back and forth on that, I think. But for now, yeah, we're going to go with the shorter one is the thicker one, the longer one is the thinner one. But in any case, I should also explain that these are exponential moving averages. So they do assign greater weight to price changes more recently than what happened 50 days ago or what happened 200 days ago. I'm not going to go deeper into the explanation of the construction of these indicators, because I consider that to be sort of intermediate to beginner. but hopefully I've addressed what their purpose is here well enough. Paul says, why not why an EMA and not an SMA? Paul, there's a lot of debate that goes back and forth on exactly that topic, and I'm not going to make the case today that we've selected exactly the right ones. Traders should always feel flexible in bringing their own preferences into how they structure their charts. The basic logic of EMA versus SMA, exponential moving average versus simple moving average. Exponential moving averages tend to be a little bit more sensitive to more recent price changes. And so they'll be a little bit faster to change with price. Now that makes them a little bit more volatile, and there are pros and cons to that. Some actually prefer the relative additional stability provided by a simple moving average, even though it's a little bit less sensitive to price changes. It can be slower to change. Just up to one's preferences, whether you like to see a marginally faster or a marginally slower change. All right. But in any case, yeah, we're using exponential moving averages today, one representing intermediate trends, the other one longer-term trends. And the first thing that a trader who's trying to zero in on the sort of weekly timing of a potential entry is to confirm, is the intermediate line above the longer-term line? So in other words, is our red or thicker line above our green or thinner line? What does that imply? Well, it implies that prices are strengthening over recent periods sufficient enough that it's pulling that intermediate line above the longer term. You might feel like, oh, isn't that the natural state of things? No. If prices are weaker for a relatively extended period of time, it'll cause that intermediate line to fall down, the intermediate trends reversing and slipping below the longer term, and it may signal that there may be possibly a lag to a longer term shift coming ahead. But bottom line here is, if our intermediate line is above the longer term, the trader might already be thinking, okay, well, things appear to be bullish. And if they're bullish, they might be planning for, let's try to refine our entries to a weekly basis for a bullish trade. So where might that entry timing occur? Well, sometimes with our intermediate line above the long term, price gets way above that intermediate. And think about what goes on in your mind when price rallies way above where it's been recently. Have you ever thought to yourself, boy, it feels like things are getting a little bit top heavy here. Yeah, the stock is having a great run, but am I a little bit late if I were to get in at this moment? That's the way that some traders think. And so they might look for a reversion back down to the trend line, getting back down to the average price over the last 50 days in this case. And so when we get down in that range, you might look at what's happening literally over this last week. When we're trading at or near that average price, the trader might actually start to think, all right, this might be the week. Put yourself in the shoes of the trader who was looking at this same chart back here. Things are bullish, intermediates above the longer term, but price has escaped well above that intermediate trend line. And there might be a concern here that there could be a quote unquote reversion to the mean. Doesn't always happen. It's not guaranteed that that's what's going to happen. But for that reason, among others, some traders might wait for things to pull back down. So here we've sort of narrowed it. We have our intermediate, to longer term indication of trend of price health, maybe you say it that way. But we're also trying to get down to within a week or so where we're right close to that moving average, trying to trade around average prices. So that's step number one accomplished. Step number two is, well, somewhere within that week, is there maybe a quote unquote better time for entry than another time? Should we buy on Tuesday or on Friday? Should we buy on Thursday or on Monday? Well, for that purpose, a trader might use a shorter term indication of what we call momentum in price. And there are lots of those. Typically, indicators that are used for that purpose are oscillators that are displayed down below the price chart. So we're going to add an oscillating indicator here. Let's go up to our edit studies icon, and there's a whole bunch. Go ahead and chat in some of the oscillators that you're familiar with. If you are among those traders who have a little bit of experience with this, and maybe you've used some of those oscillators. If you think of the word oscillating, it just means going up and down. What are some indicators that you can think of that are displayed below the chart that move up and down? Yes, CCI. Yes, RSI. Yes, stochastic. Yes, how about MACD histogram? Talked about this one a number of times in previous weeks. And I wanted to make sure that we're treading familiar territory in the early part of this discussion so that when I bring on something that might be maybe familiar to some of you, maybe not, the pivot points discussion, I want to give more time to that and get deeper into it. Because I've reviewed our recent videos. I looked through a number of them. A lot of our instructors have used pivot points, but I don't think any of us have actually explained how they're built. So I want to talk about that. Okay, yeah. John, yes. RSI, MACD, yes. Arun oscillator, volume oscillator. Let's add, did I do it twice? No, okay, just good. Hit MACD histogram. Now notice I'm choosing, there are other variations on MACD. So I've selected MACD histogram if you're trying to follow along at home. I'm going to apply that to our chart and I'm going to click OK. And let's just do a basic recap of how the MACD histogram might be interpreted by traders. Very simply, or the fastest way that I can describe it is a momentum oscillator that moves up and it moves down, crossing back and forth over what's sometimes called the signal line. Although for some traders, they might consider the signals that are generated by the signal line as being potentially fairly slow. But when we're above the zero or the signal line, you'll see that as the MACD rises, it has these bright green histogram bars. If it starts to contract toward the signal or the zero line, we transition from bright green to dark green. As the MACD falls below the zero line, we get bright red. And then as it starts to contract, as the histogram lines below zero get shorter, in other words, they appear to be moving back toward the zero line, we see this dark red coloration or scheming. So here's the interpretation. That's the construction. What's the interpretation? Well, some will look for crossovers going from red to green. I think that just makes sense. Kind of sounds like a traffic light switching, right? But others will look for a deep drop into red. And the moment it transitions from light red to dark red, they might say to themselves, this appears to be an area where momentum is shifting on the low end. This may be a signal that price is about to go back up. Is it a guarantee that price is going to go back up? Of course not. No technical indicator is a guarantee of anything that's about to happen. But a typical interpretation of just exactly the sort of event that we're getting on Procter & Gamble right now is that maybe price has come down. Momentum has been in the hands of the sellers, but in that battle between buyers and sellers, maybe there's a little bit of a subtle switch. We might be hitting a price floor here, and we might see prices rise off of these levels. And you can see when we made a switch from light red to dark red here, price rallied. Light red to dark red here, price rallied. Not a guarantee, but it can be at times quite a decent signal. You see that there and here, there, here. I think you get the point. Carol says you love it's very useful MACD histogram. Yeah, and my purpose here is never to try to convince anybody that this is the way to trade. Right? What I'm going through is an example process for how a trader might go down through the time frames. Start with a broader time frame, narrow down to, okay, this might be the week of entry. Then we move to a narrower time frame. This might be the day of entry. And then even within a given day, well, do we buy in the morning or in the afternoon? What might the charts have to say about that? But the hour MACD may be signaling for our trader we're in the week of entry. Now, possibly it's the day of entry. What about the moment of entry? I'm going to be recruiting a chart that's sometimes used by single session traders. That's not what we're going to be doing today. This is going to be refining a potential entry to just add that, hopefully, that little bit of extra, I don't know, frosting on the cake. Maybe the trader looks at it that way. Janelle, you like this? Good. All right. Well, for this one, I want to keep our 1-year chart, I'm going to add a second chart. So if you haven't seen this done before, I'm going to be using the grid up here, and I'm going to be using 2 charts. So let's choose 2 from that grid. And that brings them up side by side, but I want to look at them one at a time. So I'm going to maximize this first one. There's a little menu icon up here. I'm going to maximize this one. And so now we're just looking at this one. But if you look up here now, we have a grid, and we can navigate back and forth between them using these arrows. Do that. All right, but before we go do that, I want to gather some data because I'm going to be, no, let's do this. That's okay. Let's go ahead and we're looking at Procter & Gamble here. I'm going to add Procter & Gamble here. And then I'm just going to clean up this chart a little bit. So, it has options, expiration lines, corporate events, volume. None of these things are going to be things that we talk about. So I'm just going to clean those off. So I'm going to go up to my chart settings. Let's take care of the time axis and get rid of those expiration Fridays. Next, we'll go to our equities, take off the corporate actions and the volume, and click apply. So we just have a nice clean chart there. Now, the other thing that I want to do is we're talking about refining it to the moment, and I mean literally minute by minute. So I'm going to switch the chart time frame here to a 1-day, 1-minute chart. Right now, this one I'm going to go back here. We don't need this right now. Do you see that this one's green? That's because all of this is encapsulated in this little drawing that I made here. So I'm going to take it off. Remove that drawing so I don't have a green chart anymore. All right. But we're going to be using something called pivot points to try to refine that timing down to that moment by moment entry. How many of you, just chat in yes or no, are familiar with pivot points? Just a quick yes or no will be great. As you chat that in, I'm going to click on the edit studies icon here, and let's add pivot points. Add those to our charts. There's one customization that I'm going to make sure is done here. I'm going to go to our little gear icons. What the pivot points do is it's going to draw a series of lines, a total of either 5 or 7 lines on the chart that may represent potential areas of intraday support and resistance, price floors and price ceiling. Getting a lot of yeses, that's good. I'm getting quite a few no's as well, even among those who are saying yes. So let me ask another follow-up question. If you are familiar with pivot points, would you be comfortable in turning to a friend and explaining exactly how those pivot points are calculated as they're applied to the charts? Because it's one thing to understand how the pivot points might be used, quite another to understand exactly how they're constructed. So that's okay if nobody knows everything about every chart indicator. So don't ever feel like I'm a little bit embarrassed. You don't have to participate and say something if you just rather sit on the sidelines and watch. That's fantastic. But if you look at this, there are 7 tabs representing our 7 pivot point lines. But by default, only 5 of those are going to be displayed on the chart. You'll notice where it says show plot. That's Thinkorswim's way of saying show this indicator on the chart. It's unchecked for this thing called R3. It's also unchecked for this thing called S3. So I'm going to check the boxes for those. So I want to show all of them on our charts. Okay. Once I've done that, I'm going to click OK and click apply. And what I'm left with here are these 7 lines. And I want to talk about those 7 lines and the potential implications for the trader who's trying to refine their entry right on down to the moment. But the first thing I need to go back to this is why I want to keep that 1-year chart. Let's go back here, and I'm going to zoom in so that I can get a closer look at yesterday's candle, because these lines are all built from yesterday's information. So I'm going to grab a few points of interest from yesterday. I need the high, the low, the close, and the range of prices for the day. So the high is 171.82. You can see all this information right up here: high, low, close, and a range. Okay. So our high is 171.82. 171.82. You see me make a mistake, let me know. Our low from yesterday is 170.02. Our close going to be 170.85. And the range, if you're not familiar with the range, that's just the difference between the high and the low. How big was the candle, top to bottom? Our range was $1.80. Okay. Because these are the elements of this indicator that I'm going to be showing. Let's go back to our pivot points, and we have these 7 lines. Let's talk about the first line from which all the other 6 lines are derived. This is known as the pivot. That's our purple line. So we need to know how to calculate the pivot. Now I'm going to be using a lot of abbreviations. Our pivot is just an average of yesterday's high, low, and close. Okay. So it's just the high. There we go. High plus the low. Good grief, I'm not great with my typing at the moment. High plus the low plus the close. Then we just divide those by 3. And that gives us our value. So high, low, close, add those up, divide by 3, and that gives us our pivot value, which right now is what? As I point at that, it's getting a little bit obscured. I might have to, well, let me point up here. There we go. Now we can see it. 170.104. So if you're wondering where that pivot came from, it came from yesterday's high, low, and close. Now we have these other lines. We have 3 red lines here representing potential price ceilings or resistance levels if there's an intraday attempt for a rally. Now below that are potential price floors, price support levels, if the price happens to sell off below the pivot point or the average price from yesterday as determined by the high, low, and close. Now these, as you can see, boy, that might be interesting. If we pull down to a support level and start to rise again, this is a bit of a spoiler alert. Could a trader look for a potential entry? Might that be the moment of entry? Could be. Let's talk about where these come from. So we have a series of things. We have we'll call them, these are the labels that are typically given. We have R1, we have R2, we have R3. The R stands for resistance, so we just have resistance levels 1, 2, and 3. And then we have support levels 1, 2, and 3. There we go. All right, so let's focus on R1 and S1, support 1, or resistance 1 and support 1. So those are just going to be the 2 lines that are closest to our pivot. And they might be the ones that traders pay the most attention to on the most regular basis because they're the ones that are reached most commonly by price activity intraday. So the resistance 1 is, well, how do I want to say this? Basically, what we're looking at here is we are taking yesterday's candle, the range in prices, and sort of fitting it right around our pivot. That's conceptually what's happening. So to do that, what we do to calculate our resistance 1 is we take our pivot and multiply it by 2 and then subtract yesterday's low. Right? So our pivot is 170.104. Let's do some quick math here. 170.104. Multiply that by 2. That's 342.08. And then yesterday's low was 170.02. So we're going to subtract 170.02 from that value. That gives us 172.06. Yeah, and there can be a few pennies. Markets are still moving a little bit here and there. There can be some rounding. But yeah, that's where that first resistance level is coming from. And you might suspect that the S1 is a variation on this thing. Our support is that same, we just take our pivot, multiply it by 2, and instead of subtracting the low, which is a smaller number, resulting in a higher level, we subtract the high. So our high, let's do our calculation again. What was this? Let's just make a note of it over here. So our pivot, I already did. is 171.04. So 171.04 times 2, 342.08, minus yesterday's high of 171.82, 170.26, which is, did I do my math right? Nope. Got to do that again. I didn't multiply it by 2. 171.04. Oh, yeah, that's right. 170.86. Missed it. Anyway, 171.04. I'm not going to do those with everything, but I just want to get the flow of the discussion going. For the calculations, let's multiply that by 2. Subtract yesterday's high of 171.82. That gives us 170.26. There we go. Yep, nailed it. All right, but to get the point, so we take our pivot times 2, subtract the low and the high. The effect there is that it positions yesterday's range of $1.80 around the pivot. In other words, if we look at the R1 and subtract the S1, that's $1.80, with the pivot point sitting somewhere in the middle, biased a little bit based on where yesterday's close and open were. All right, now, what are these other levels? R2 is just a straightforward calculation. We take the pivot here and add yesterday's range. Now, sometimes this is expressed as pivot plus the high minus the low. If you look it up on Google, that's what it's going to say. Well, high minus low is just the range from yesterday. So we take the pivot plus the range. R3 is our pivot plus our range times 2. And our S2 and S3 are just the opposite. So it's the pivot minus the range and the pivot minus the range. There we go. All right. So if you are a veteran user of pivot points, but you wanted to add a little bit of polish on your understanding of the construction of these, that's how they're constructed. If you're brand new to pivot points, this is the basic construction, but the real logic here is to calculate an average price from yesterday, high, low, and close, giving us an average-ish, right? And then we're looking for measured departures from that average. Do we go down a full range of yesterday's price and hit this low? Do we go down double yesterday's range and hit that low? Do we stay within yesterday's range, which is these two lines? Do we rally up a full range or 2 ranges? That would be considered by some to be sort of an extreme overbought scenario in the very short term. That's the bottom line of everything that we've just discussed in the construction of our pivot point. So is that a bit of heavy lifting? Yeah. Can you see why I wanted to give that a little bit more time in the discussion today? I think you can understand that. Sharon, you're welcome. Here's what you may want to do if this is your very first time being introduced to the calculation of pivot points. Go back after this webcast is over, find the archive. This is among those that are scheduled to be archived to our Trader Talks channel, and just go through that last 10 minutes or so. Maybe try to do these calculations on your own on some stocks. Just, they're fairly straightforward little equations that calculate these lines. But now let's get to the fun stuff. Close that out. Let's talk about the potential for application for our trader who's gone to the heavy lifting of trying to define down to within a week where they might want to buy their stock. They've done some additional heavy lifting, and they've tried to refine down to the day of when they're considering a stock trade. And now they're getting down to the moment. Here, what we're now seeing, if you're not familiar with looking at intraday charts, this gray area is the aftermarket and pre-hours trading. The white space is just today's activity, just minute by minute. Janelle, you absolutely plan to watch this again? Excellent. All right. So minute by minute, this purple line represents sort of the average in yesterday's trading. You can kind of see that. This white space out here is yesterday. And if you were to just eyeball an average, you can see how that kind of falls in the middle. right? Sometimes trading below that, sometimes trading above that. And where do we find ourselves at the open? Trading below yesterday's, and I'm going to call it average with quotes because it's not a true average. A true average, we have to add up all of the prices from all day yesterday and then divide it by all of the ticks from yesterday, and that would be kind of a nightmare. So instead, high, low, close, what's the average of that? Well, today, we've been coming down. Prices have been coming down over the last several days. Is that a negative thing for a trader who's maybe trying to buy low, looking ultimately to hopefully sell high? Well, it might be a positive thing. So we've opened below yesterday's high-low close average, and we've moved down, but still within a one-day range of trading. Does that make sense? I'm gonna draw that in. I'm gonna do that right here. So from R1 down to S1, it's the same basic distance as yesterday's high down to yesterday's low. Can you see that? Anyway, so we're still sort of trading within a range, but on the lowish end of that range. So for some traders, if we get down to that low end of the range, we find support at that S1 level, the support 1 level, and we start to get white candles rising off those levels, that may be the moment of entry. Week, day, moment. Now, not every chart is going to stop selling at that point. Where might be the next level they look for an intraday entry, or that moment by moment entry? Might be down there at S2. Yep. Where now we've fallen below the high-low close average, and we've gone one full range all the way down. That's what that is. But looking for entries down below these lows, that's one way. What if price is strengthening though? What if our MACD is low and rising, our 50 is above our 200, and price is trading right around that? So all the more macro timing elements seem to be in place, but the momentum is really shifting and we're going higher. Well, for a trader entering just below one of these resistance levels, that might be the moment where they say, hold on, I'm gonna hit the pause button and wait, see if we can get up through a price ceiling. Breaking through a price ceiling into a new range might be seen as a signal that we might be moving up to the next level or potentially the next. But in any case, what I'm not going to discuss today is getting back out of this within the same day. That's not the purpose of this setup. How might the trader plan for the exit? Well, they might go back to that macro view and look to see, are we hitting resistance levels on that daily chart? Are we hitting targets there, or is the trend changing? But once they've determined on that weekly and daily view, it's time to pull a plug. Maybe they come back to their pivot points and see if maybe we're bumping up against a price ceiling, for example, as an exit. Let's see. Lynn Ramirez says, Trader Talks, you have extended hours checked under equities and still have dots across your entire chart. I'm not sure, Lynn, what change we might need to make there. I'll have to leave that one. Chris says, okay, Chris, you're talking with another. Perfect. All right. Anyway, but this is sort of interesting with Procter & Gamble. How might our trader literally be feeling at this moment? I can't ever plan this because I don't know what the stock is going to be doing at the moment I'm talking to my audience. But it is interesting that we still have on that longer chart. Let's zoom back out. Is our red still above our green? Yep. Are we still trading at or near that 50-period moving average? Yes. Are we still seeing that MACD transitioning from bright red to dark red? Yes. And on an intraday, on a same session basis, what's going on with prices? Well, they've come down. They've come down from a relative high, and they're trading right close to that average, that high-low close average from yesterday. starting to show some strength, trader may look at that and say, yeah, that's good enough. If I'm just trying to add a little bit of polish to my entry, maybe instead of getting in at $171.77, maybe I've saved myself 50 cents on this entry. And that savings is still there regardless of how the trade turns out, right? But the stock could still go down. It's not that there's not loss potential. Anyway, let's go ahead and place our trade. I'm going to go to our trade tab. Let's just say today's the day. We're going to buy some shares of PG. It's a $171 stock. 100 shares would be about $17,000. In this portfolio, we have about $300,000. So $17,000 in a $300,000 portfolio, that's only 5.5%. So I'm going to go ahead and do that trade. Let's click on the ask price. And let's buy 100 shares of PG. I'm actually going to submit this as a market order. Obviously, when submitting a market order, we're taking a risk that we might not be thrilled with the price that we receive. You'll get a little reminder right here with market orders. Prices can change quickly in fast market conditions, resulting in execution prices that can be different from the quotes displayed at order entry. We're not, just because it's trading at 171.23, when we submit a market order, we're not guaranteed that price. We'll have to see. Not a commission on this trade, but there can be on some types of trades. Let's send that order off. There we go. Just bought those shares. Guys, and let me just check one other thing. Go to our monitor tab. Yep. Okay. I intended to route that to my IRA, and that's exactly where it is, the example IRA. But everybody, we have accomplished what I set out to do. I wanted to talk about using charts to plan entries, plan the week of a trade, the day of a trade, and even the moment of a trade. And for some of you, that required the recruitment of a new indicator, pivot points. Now, obviously, some of the rest of you are familiar with that, so I did want to give you a little bit more. For those that are more veteran who still want to polish things, we talked about how the thing is built. So I hope you enjoyed that, everybody. Time for me to let you go, but as you do, there are definitely some things I want you to be aware of. Number one, a lot of you are aware of this already, but there are big changes. There are changes coming up in 2025 to our webcast schedule. Not to this webcast. This one's staying in the same place, the same time. It carries the same title. It's the same webcast series. No changes. However, if you go to schwab.com/coaching/webcasts and you scroll down to our calendar, you can look through the calendar and see what's coming up in 2025. And so for my schedule specifically, I'm getting more webcasts. So I'm moving from 4 a week to 5 a week. One of my webcasts is getting longer, going from 25 minutes to 45 minutes. And I've done a little bit of shifting of which webcasts I'm delivering. So on Mondays now, I'm going to be doing trading calls and short puts. That's at 2 Eastern. On Tuesdays, I have Getting Started with Options. I'm switching with Barb. She's going to be taking my Getting Started with Technical Analysis. I'm going to be taking her Getting Started with Options. On Wednesdays, we're back here at 2 o'clock Eastern for Getting Started with Thinkorswim. So we're keeping that series, just moving it from Monday. On Thursday, I have Long Verticals and Diagonals, new webcast series for me. And then Friday, where is it? There it is. Advanced Charting Techniques, still 1 o'clock Eastern. Janelle, you love these? That's excellent. Great to hear. I hope you enjoyed today's discussion. We still have lots to come even today, so go watch those other webcasts. But also make sure that you are subscribed to our YouTube channel. If you haven't done that already, you can just pop down below the display window, click on the subscribe button. It only takes a second. It doesn't cost anything. But our YouTube channel is the very best place to find our playlist of previous webcasts. If you've enjoyed previous series, but you haven't seen all the videos, they're going to stay on there. You can go catch those playlists right there. You can also join our live streams right here. Now, another thing is to make sure that you are following Connie and me on X. You can find Connie at Connie Hill CS. You can find me there at Cameron May CS, but this is the best place to connect with your favorite presenters in between the live streams. And it also doesn't cost anything to follow. So follow us there on X. Love to have you there. Time for me to let you go, though. Mark says, where can you find that calendar? So the web address is just schwab.com, and then you just go to /coaching/webcasts. All right. Everybody, thanks for the thumbs up. Yes, Carol says, click those thumbs up. It looks like out of the 179 people watching right now, we have 65 that have already clicked that thumbs up. That's really appreciated. Always sounds like applause to the presenter. It also helps your coach's webcast get a boost in the YouTube algorithm and just find a broader audience. So it's always appreciated. Everybody, thanks for giving me your time today. I'm going to let you go. I'll look for you in future webcasts. I'll also look for you on X. But whenever I see you again, until that moment arrives, I want to wish you the very best of luck. Happy trading. Bye-bye.